Imagine waking up tomorrow and discovering that your retirement savings have lost 40% overnight. The stock market is in freefall, businesses are shutting down, and the word recession dominates every headline. For millions of people, this isn't just bad news, it feels like the end of everything. Across the country, fear spreads faster than facts. Investors rush to sell. Families worry about paying bills. Businesses freeze hiring. Everywhere you look, panic replaces confidence. But while millions are desperately trying to escape the market, a small group of investors quietly logs into their brokerage accounts, not to sell, but to buy. Why? Because they understand something most people never learn. Recessions don't simply destroy wealth. More often, they transfer it from those forced to sell to those prepared to buy. History has shown this pattern again and again. Every major financial crisis creates fear for the unprepared, but extraordinary opportunity for patient investors. By the end of this video, you'll discover why billionaires often become more aggressive during recessions and how you can apply the same principles even if you're starting with very little money. Welcome to The Money Code, where we break down the strategies the world's greatest investors use to build lasting wealth through knowledge, discipline, and long-term thinking. Today, we'll uncover the hidden wealth transfer inside every recession, explore the psychology of the rich, examine real historical examples, and build a practical roadmap you can use yourself. Every recession begins the same way. Fear takes over. Rational thinking fades. Suddenly, people stop asking what's valuable and start asking what's safe. Many investors don't sell because they want to. They sell because they have no choice. Lost jobs, emergency expenses, and mounting debt force them to liquidate investments at the worst possible time. But every seller has a buyer. On the other side of every panic sale is someone calmly purchasing those same assets, often at prices that won't be seen again for years. These buyers have one major advantage: cash. Investors call it dry powder, the ability to move when everyone else is frozen by fear. Recessions are like a chess match. While the crowd reacts emotionally to every move, experienced investors quietly think several moves ahead. Legendary investor Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." That mindset has earned Berkshire Hathaway billions across decades of market cycles.
The wealthy don't wait for recessions to prepare. They build cash reserves, strengthen their finances, and develop the emotional discipline to act when everyone else is afraid. Next, we'll uncover why recessions turn the world's best assets into bargain opportunities, and how legendary investors identify value while everyone else sees only risk.
Imagine walking into your favorite luxury store and seeing everything marked down by 50%. You wouldn't panic, you'd probably start shopping. Yet when the stock market offers the same kind of discount, most people run away. Here's the mistake many investors make. They confuse price with value. A company's stock price can fall dramatically while the business itself remains strong, profitable, and capable of growing for years to come. Warren Buffett once said, "Bad news is an investor's best friend." Not because he enjoys crises, but because bad news often creates extraordinary buying opportunities. During recessions, it's not just stocks that become cheaper. Real estate, businesses, commercial properties, and even investment opportunities that once seemed impossible suddenly become accessible. In March 2009, fear reached its peak. The S&P 500 had fallen by more than half from its highs. Headlines predicted years of economic pain. Yet that moment became one of history's greatest buying opportunities. The investors who succeeded weren't the ones who perfectly predicted the bottom. They were the ones with enough courage to buy while everyone else waited for certainty. But courage alone isn't enough. The wealthy possess another powerful advantage, one that gives them the freedom to invest when opportunity appears. Professional investors call it dry powder. Cash held in reserve for moments exactly like this. While others scramble for liquidity, they're ready to deploy capital. Liquidity isn't exciting during boom times, but during recessions, it becomes one of the most valuable financial assets a person can have. The wealthy don't react to today's headlines. They ask a different question. Where will this business be 5, 10, or 20 years from now? During the financial crisis of 2008,
Berkshire Hathaway invested billions into Goldman Sachs under terms that reflected the extraordinary fear gripping the market. Notice what Buffett didn't do. He didn't predict the exact day markets would bottom. He simply prepared long before the crisis and acted when opportunity arrived. Most people see falling prices and think, I'm losing money. Wealthy investors often see the same prices and think, I'm buying tomorrow's profits at today's discount. If the market dropped 40% tomorrow, what would you do? Sell out of fear? Wait on the sidelines? Or see it as the opportunity of a lifetime? Your answer isn't determined by intelligence. It's shaped by preparation, emotional discipline, and your understanding of how wealth is truly created over time. Next, we'll examine the historical evidence behind every major market recovery and why the biggest fortunes are often built during the darkest economic moments. Here's something remarkable. Every major market crash has felt like the end of the financial world, yet history tells a very different story. The darkest moments often become the starting point for extraordinary recoveries. In 1974, investors believed the future looked hopeless. Inflation was high, markets had collapsed, and confidence disappeared. Yet those who stayed invested witnessed one of the strongest recoveries of the decade. Then came Black Monday in 1987. Markets crashed at breathtaking speed. Many believed investing was finished. But within years, markets recovered and continued reaching new highs. After the dot-com bubble burst, countless technology companies disappeared. But the strongest businesses adapted, survived, and laid the foundation for the digital economy we know today. The 2008 financial crisis was different. Banks collapsed, housing markets crashed, millions lost jobs. Fear consumed the global economy. Yet those who continued investing were rewarded over the following decade. Then came the COVID-19 crash. Markets plunged at record speed. Yet the recovery that followed surprised even experienced investors, proving once again how resilient markets can be over time. Different crisis, same pattern. Fear, selling, recovery, growth. Human emotions change very little, but patient investing continues to reward those willing to look beyond today's headlines. Successful investors don't ask where the market will be next week. They ask where innovation, businesses, and the global economy will be 10 or 20 years from now. That's the difference between traders and investors. Traders react to today's moves. Investors think several moves ahead, like grandmasters playing chess. So what exactly do wealthy investors do differently? Their success isn't built on luck. It's built on repeatable principles they followed for decades. First, they prepare before the storm arrives. During booming markets, they strengthen their balance sheets, reduce unnecessary debt, and build cash reserves for future opportunities. Second, they master their emotions. Markets fluctuate every day, but emotional decisions have destroyed more wealth than recessions ever could. Third, they don't chase hype. They buy businesses with strong fundamentals, healthy cash flow, competitive advantages, and capable leadership. Fourth, they measure time differently. While many investors think in days or months, the wealthy often think in decades. Finally, they understand they don't need to buy at the exact bottom. Instead, they invest consistently, adding more as opportunities improve and fear increases. Now that you understand how the wealthy think, it's time to answer the most important question of all. How can you apply these same principles starting today, even if you don't have millions? Here's the best part. You don't need millions of dollars to invest like the wealthy. Their greatest advantage isn't simply money. It's preparation, consistency, and patience. Those are habits anyone can begin building today. Step 1. Build an opportunity fund. Unlike an emergency fund, this money is reserved for taking advantage of exceptional investments during market downturns. Step 2. Never stop investing. Consistent monthly contributions allow you to buy more shares when prices fall, turning volatility into a long-term advantage. Step 3. When markets experience major declines and fear dominates the news, consider investing additional capital if it aligns with your long-term financial plan and risk tolerance. Step 4. Focus on quality. Whether you choose diversified index funds or carefully researched individual companies, prioritize businesses with durable competitive advantages and strong financial foundations. Step 5. Master your psychology. Markets rise and fall, but your emotions don't have to. The investor who remains calm during uncertainty often gains the greatest long-term reward. Step 6. Strengthen your income. The more resilient your earnings, the more opportunities you'll have to invest when others simply can't. Remember, wealth rarely appears overnight. It grows through hundreds of disciplined decisions repeated consistently over many years. But let's be realistic. Investing during recessions isn't risk-free. Markets can continue falling, and some businesses never recover. That's why preparation matters more than prediction. Never invest money you'll need in the next few years. The true advantage comes from giving quality investments enough time to recover, grow, and compound. No one consistently predicts market bottoms, not even the world's greatest investors. What separates successful investors is preparation, not perfect timing. The next recession isn't a matter of if, it's a matter of when. The real question is, when that day arrives, will you be forced to sell or prepared to buy? Every recession creates a transfer of wealth, from those driven by fear to those guided by preparation. The side you end up on depends on the decisions you make long before the next crisis begins. The wealthy don't possess a crystal ball. They rely on patience, discipline, liquidity, and the confidence that comes from understanding history. If this video changed how you think about recessions, don't keep that knowledge to yourself. Like this video, subscribe to the Money Code, and share it with someone who needs to hear this before the next market downturn. Remember this, recessions don't last forever, but the decisions you make during them can shape your financial future for decades. Prepare today, stay disciplined tomorrow, and let time become your greatest investment partner. Until next time, keep building wealth, one smart decision at a time.